Welcome to Wealth Well Done. Together, we'll cover a wide range of important topics surrounding money and the impact it has on our lives. From the sophisticated and highly valuable planning techniques of the ultra-wealthy to the commonly underutilized biblical teachings. Together, we'll work to improve our relationship with money and our effectiveness in stewarding it well. Here's your host, Eric Scovill.
All right. Welcome to the 25th episode of the Wealth Well Done podcast, where we go after the tactical, practical, and spiritual advice to help you do your wealth well done. Last week the last couple of weeks here, we were blessed to have Brandon Hall on. Brandon Hall, CEO and founder with Hall CPA and Tax Smart Insiders, or Tax Smart Investors. And I'm part of Tax Smart Insider Group, but Tax Smart Investors. He came on and we got to cover a lot, especially on the business side of things. And this week here and this week and next week, we're going to have on Thomas Castelli, his partner in this. And Thomas is, I think his main task is running the Tax Smart Investor Group. And so we're going to dig in deep on that today. So Thomas, I'm so grateful to have you on here.
Thank you for having me. It's an honor to be here too. Thank you.
Yeah. As we get into this, the disclaimer as always is that this is intended to be educational, informational here, not meant to be financial advice to you. Even though Thomas is a licensed tax professional, he is not giving you tax advice. So at that standpoint, please consult your own financial team to decide if these things are a good fit for you. But nothing here should be construed as actual financial advice. All right. So Tom, we were given a lot here the last couple of weeks with Brandon. Will you maybe, before we get into that, just give us a brief bio of who you are and why you're qualified to talk about taxes and real estate?
Yeah, sure. Absolutely. So my name is Thomas Castelli. I'm a CPA, certified financial accountant. Certified public accountant, right? And so I work with real estate investors to help them keep more of their hard-earned dollars in their pockets and out of the government's through proactive tax strategy and planning. Over my career, I've been fortunate enough to work with hundreds of investors at this point doing this, and accumulatively have saved them millions of dollars in taxes. And so I work with them on everything from the real estate professional status, short-term rentals, to home offices, paying children through businesses, entity structuring, pretty much everything in between. I also invest in real estate myself. I was on a sponsorship team of an 82-unit apartment complex that we since have taken full cycle. And now I just invest as a limited partner in multifamily, industrial funds, things like that. So I can stay focused on helping people reduce taxes. So that's just a little bit about me.
Awesome. Appreciate it. We're probably going to hit every one of those topics today. So, all right, let's jump in. For those of you who didn't listen the last couple of weeks, as we talked about here, this Tax Smart Investor Group that you and Brandon have, it's an online forum that you can get in, and you have just a ton of content. Not only the stuff that you have produced of videos to help people understand how to analyze a Schedule C or any other. You got a ton of videos out there to help people understand taxes. But then people just get in and submit their questions, and you have their answers, and all of that's saved there for people to go in and search. What about a 1031 exchange? If you type in 1031 exchange, you're going to get a ton of answers of very specific questions that someone has, and then you guys answer back. It's a monthly subscription that we have. I am absolutely a paying member here, and I would have easily paid you 10 times the amount that I'm paying you, because the advice that I've gotten out of that, it makes me better. I am more equipped as an investor, and for handling my own taxes. It has certainly made me look smarter and be more helpful to my clients. So I am a huge proponent of this, and I don't mean this to pump the tires of the guest here. I am absolutely a fan of this. And as someone gets into taxes, and we've been trying to help illustrate this whole idea of most of us are relatively ignorant when it comes to taxes. Again, relative is the key word here, but if you make $600,000, you pay $200,000 in taxes. Most most people are not a third as smart in taxes as they are in the way, whatever industry it is that pays them that $600,000.
Right.
And so having a resource like what you guys have created is so valuable, because there's no cap to how many questions I can ask about this. And what we've been discussing since the beginning of the show is all CPAs are not created the same.
Right.
And shame on some CPAs, sure, just like financial advisors and lawyers and all that, and doctors in any profession.
Right.
But in general, a lot of CPAs are really, really, intelligent, but a lot of it falls back on the investor too, and
right.
the investor, the client. And if they don't know what to be asking, if they don't know enough to show that they have the understanding or the capacity to get into something like real estate professional test, which we're going to spend a lot of time this week and next week talking about, if they don't show they've got the capacity for that, a CPA is not doing them a favor by saying, hey, go look into this. Like, that's not good for them. So having a forum like you guys have created is nearly impossible to put a dollar value to for what that does to someone. It changes them from, I just pay taxes and pay whatever I'm supposed to pay, and my CPA tells me here's how much you pay and if you pay quarterly or not, to I am now an investor. When I make that mental transition into investor or entrepreneur, from a tax standpoint, it changes everything.
Right. Big change when you make that transition.
Yeah. So can you give us just a little bit of context around this group? Like how many members are part of that forum?
Right. So that's a great question. Right now, I think we have like 280 something members that are members of the Tax Smart Insiders group. And then we have all of our clients that are, a majority of our clients are also members. So I think we're sitting around somewhere between like 650 to like 700. I'd have to double check right now. But we have a decent amount of members in there. And to your point, it's a great place to get answers to tax questions. And we've been fortunate enough to be able to help a lot of people like yourself to be able to help that. So It's been awesome.
Yeah, many of those members active, and then because you log in, and I submit a question, and I don't submit simple questions. I get complex and detailed, and then typically within 24 hours, I get an email saying, "Hey, your answer's in there."
Yeah,
and it's great. So I'm a big proponent of what you guys have created there. All right, so what I want to dig into now is we left off last week with Brandon getting into some stuff around business owners, and I'm going to bring this into everyone here because I often recommend to even my W-2 friends as well that they should have a side hustle that qualifies them as a business owner,
right?
With a big asterisk by that, saying, so long as this fits your life and your goals of what you're trying to do. If you are trying to save money in taxes, or you're trying to grow your income, then absolutely you should be doing this. If adding a new complexity in your situation is going to keep you away from your family and in a negative way, then by all means, that's not the right idea. But I certainly believe in this. There's the concept of putting your hand to something that the Lord can bless. There's just such a freedom, and the entrepreneurship is a gift. Hopefully it comes with a financial gain, but then there are these major tax benefits as well. And so some of those are very misunderstood and abused, and I'd like to hit a couple of those just to be helpful to people who are dealing with this. Yep. And then we're gonna get into reps here. So home office. At what point can I take a home office deduction? Like, how much do I need to work from home, or what does that mean? Do I need to have my own business? So who can take a home office deduction? Yep. And then I've got a series of follow-on questions.
Yeah, absolutely. So you do absolutely have to be a business owner to take a home office. Prior to the Tax Cuts and Jobs Act of 2017, you were able to, if you had a W-2 job, claim the home office deduction if it was primarily for the convenience of your employer. But that has since went away, so you can't do that as of this recording. You have to own a business. So kind of some of the requirements for a home office, you're going to have your home office needs to be your exclusive place of business. It has to be your principal place of business, right? So it has to be the place where you primarily meet with clients or patients if you're a doctor, or if you have, like, in certain situations, like where you own rental property or you have a business where you're not in the office all the time. It's the primary place where you're doing your administrative work, like your bookkeeping, your appointment setting, all that type of stuff. So it has to be your principal place of business. So if you have like another office, it's very challenging to qualify for a home office if that's, you go to the office every day and that's what you work out of a different office. So that's kind of the first requirement.
Okay, so a chiropractor who sees patients at their office, but then does all of their administrative work at home. They start their day. They're in their day at home doing work from their home office.
Right.
Would that qualify, not, or is that in the gray area?
Yeah, I mean, some of this stuff is in the gray area. You could sometimes kind of dance around some of it, but typically speaking, it needs, if you have another office that you're primarily doing your work at, then you typically can't claim the home office. The home office needs to be your primary place of business.
Okay. All right. Let's get into how do you calculate. So assuming that it qualifies there, then how do you calculate how much of a deduction you get? Percentage of the square footage,
right?
Percentage of rooms, like what? How do you do that call or that deduction?
Yeah, that's a great question. So, so the secondary piece to this, and it's going to kind of turn into this question, is also the home office itself needs to be exclusively used for business, right? So, in other words, the home office can't be a space where you also do personal things. So, kind of to clarify into that kind of drills into your next question is. What you can actually do. So the home office itself does not need to be an entire room. It can be a room, but it could be a section of a room. So for example, if you have like a garage, or maybe you have like a den or something like that, the home office can be just a portion of that room where you exclusively use that portion for business. So the way you typically deduct the home office, there's two ways. The first way is what's known as like the safe harbor method or the standard method, which is where you just take $5 per square foot of your home office up to 300 square feet for a maximum deduction of $1,500 or $1,500. So that's the standard method. Now the next side of it, you have the actual expense method. And the actual expense method, you have to determine the square footage of your home is typically how it's done. So from there, you can multiply the square footage of your home, the percentage of your home. So you take basically the percentage of your home office, the square feet, divide that by the square foot of your entire home, square feet of your entire home,
Yep.
And you're going to get a percentage. That ratio, you're going to multiply that ratio by the expenses related to your entire home. These expenses are commonly include your mortgage interest, the principal is not deductible, utilities, perhaps repairs and maintenance that relate to your entire home. Like internet costs, things like that. And then also, so you do that, you get that ratio, you multiply by those expenses, that becomes part of your home office deduction. Now, anything you do to the home office itself, like a desk, like any repairs or maintenance or like furniture, things like that you'd have in the home office, that's typically going to be 100% deductible because that's going to be related directly to the home office. So That's typically the way to do it. Now, there's another way you can calculate the ratio that I mentioned, and that's by room. So you could say but usually when that's used is if you have a house or a home where most of the rooms are the same size. So if you say you used 1 out of 5 rooms, well, now you have, what is that, 20% of your house, right? But typically what we see is the square footage methods used most. Again, you divide the square foot of your home office by square feet of your entire house. You get that ratio multiplied by your expenses, and that's kind of how the actual expense method works.
Okay, and then so I could deduct. So if that's 20% of my internet bill,
right,
is going to come off of that. Okay. How about landscaping?
Landscaping, that's an interesting one. Landscaping, there's a tax court case out there that basically says landscaping does not count. There's an argument you can make that like if you need it to maintain the appearance of your home, but for the most part, landscaping from the one tax court case that we're aware of indicated that it typically does not count.
Okay. All right. Here's another one that is a little, well, okay, sorry, before I go into that, what about, so mortgage principal does not count, but what about rent?
Rent, yes, rent can count. So if you do rent, then you can typically deduct a portion of your rent, kind of using the same 20% we're talking about here.
Okay, so a lot of the, so we've seen a massive spike in the number of pools that have gone have gone in lately. And so someone who's using their home office, they entertain out of their house as well. And then how does the pool maintenance and any of those expenses, would that fall into the same thing, kind of landscaping, like don't go there? Or
Yeah, I would say probably.
And this, by the way, I'm just asking your opinion. Every person listening is going to go talk to their own CPA and get their CPA's opinion on this. So
Yeah.
just helping educate.
Yeah, I would have to dig in to see if there's any specific tax court cases on that before saying yes or no. But like, just kind of just knowing how this stuff works, I would have to urge just like off the bat, off the top of the head here, I'd probably say probably not.
Yep.
I would say probably not.
Okay. Yeah. All right. Vehicles. So vehicles had this interesting turn where we have the 6,000 pound limit here, and for the farm vehicle, and now all of a sudden we got business owners driving around a G-Wagon and saying that this is their farm vehicle. So talk to us about vehicles and what
right, yeah,
counts as a deduction.
Yeah, so that's a great question. So there's, like the home office, there's kind of two different deductions for vehicles. One of them is the standard mileage deduction. Very, very simple. It's you take the amount of miles you drive for business and you multiply by the standard mileage rate. And the standard mileage rate for 2023 is 65.5 cents per mile. So for example, if you were to drive, let's just say you would drive 10,000 miles for business this year, you're going to multiply that by 65.5 cents, and you're going to get a deduction of around $6,550, right? That's the simplest method. What you just need to do there is you need to have an IRS compliant mileage log. There's apps like Everlance and MileIQ that can do that for you. So you need to know the odometer for the beginning of the year, the odometer at the end of the year, and then you have a log of each business trip you took, and just a kind of a note on how many miles it was and what the purpose of that trip was. So, and the trip. So that's kind of the standard mileage method. Next one is the actual expense method for vehicles. To do this one, you need to use your vehicle more than 50% for business to even use this. So you use your vehicle, and that's determined by a mileage log. So even if you use the actual expense method, you're typically still need to keep that mileage log. So that one is very similar. Like say if you drove 10,000 miles for business and or 10,000 miles total, let's just say, and 6,000 for business. Well, now you have 60% business use of that vehicle, and 60% of the expenses related to that vehicle are going to be tax deductible. So things like gas, oil changes, repairs, maintenance, insurance, warranty.
And this is something you can decide at the end of the year. So if you typically do a mileage deduction, but I just had to replace the transmission in my truck, and so thank you, GM. So if you have a big expense like that come in, then you could decide that before you file your taxes.
Right. I will say that once you go the actual expense method, though, you can't go back to the standard method. So you could use the standard mileage deduction for say a few years if you wanted to, if that made sense for your situation, and then convert over to the actual method. But once you go to the actual method, that's kind of it. You're kind of stuck on that method. So
for that vehicle, but then when you buy a new vehicle, you can switch.
Yeah, typically you're able to make that switch at that point, but once you have the standard mileage deduction for that vehicle, that's the method you chose.
You're committed. Okay, and how about then for writing off the vehicle itself?
Yeah, so that's another great question. So basically, the way it works is this: if you have a vehicle that has a gross vehicle weight rating, so it's a GVWR as they call it, of 6,000 pounds or more. Then you're typically able to bonus depreciate the business portion, right, of that you use. So say you purchased a $50,000 Ford F-150. In that case, that has a gross vehicle weight rating of over 6,000 pounds. You're going to go ahead and multiply that by 60%. Let's say you use it 60% for business. Then that's going to give you $30,000. Now, this year, as of this recording, this is being recorded in summer 2023. You're looking at a 80% bonus depreciation. That's what we're looking at this year. So you'd be looking at like a deduction around $24,000, give or take, depending on the specifics. But that's kind of how that works. Yep. Now,
Okay.
If the vehicle weighs under 6,000 pounds, or has a gross vehicle rate weighting, to be specific, of under 6,000 pounds, it's typically considered like a luxury or a passenger vehicle, as they would call it under the tax code. And at that point, you're not eligible. You're capped on the amount of depreciation you could take. And I'm pretty sure it's around 22,500 this year, if I'm not mistaken.
Okay. All right. And that's the max that you can take out of it. It's not on a 5-year depreciation schedule or something.
But the
like
rest
that.
of it would be depreciated over a 5-year, over the remaining schedule. But in terms of
up to the business usage percentage.
Right.
Okay. Yep. All right. I'm with you. Okay. Thanks for explaining that. That's helpful to me too. Okay. Next one. Paying your children. So this is one that I've seen as a phenomenal tool, and also highly misunderstood and misused as well. And I know kind of these, the reason I'm choosing these things is I know these can be pieces. We got into this a little bit with Brandon about audits,
right.
And so we'll maybe come back to that at the end of this. Is just let's understand as we try to use these deductions, what that's doing to our chance of getting audited. But paying your children is often one that is misunderstood there, and so you can pay your children, and you can pay $12,000 now. Or just 13. I don't know what that's up to now that you can pay without having to owe taxes.
Yeah, so it's going to be up to the standard deduction, and that's going to be $13,850 for 2023. And that, so that's if you pay them below the standard deduction. Typically, you do not have to file a tax return for them if they're a W-2 employee, and because they're under the standard deduction, and therefore they typically receive that money tax free.
Okay, and are they just a W-2 salary employee? Does that need to be through some separate LLC, or I can just have them as a W-2 employee? I pay them $13,000, and therefore they don't have to pay taxes on it.
That's a great question. So typically, if you're a sole proprietor, so if they work for their parents and as a sole proprietor or a partnership, a husband and wife partnership, then you would just have a W-2 for that business, and they're not going to be subject to self-employment tax as well, right? But if you start getting into the realm of S corps or corporations, then that's when you typically see exposure to the FICA tax or the self-employment tax, and at that point, you might see some people do like a family management company where they'll set up a sole proprietorship, or like an LLC tax that's disregarded, or husband and wife partnership, hire their kids through the husband and wife partnership, and then kind of like contract out to their other companies. So, for example, you might have like the S corporation. Say you're a real estate agent, I'm just pulling a business out of a hat here. That's taxed as an S corporation. Well, if you go ahead and hire your child under that S corporation, they might be exposed to that tax that I mentioned. But if in that case, you typically would see someone create that management company, and then just the S corp would hire them from the management company. That said, the management company, there are some people out there who believe that could cause some issues under audit. It's hard to say for sure, but that is not like 100% risk-free strategy in some situations.
Okay, so this is really powerful. I mean, family so we got 3 kids, and that's $40,000 that we could take off of our taxes by paying our children. Obviously as a financial advisor, and the ability, now they've earned income, so now they can save into a Roth. So each of our kids can max out a Roth IRA at that point from a young age, and man, the compound impact of that is massive.
Right.
So huge piece of that. The rest of the money could go into a fund, into a bank account for each of the kids that we use for their expenses.
Right.
And it seems like I hardly know anyone who doesn't have some kid in some sport that's way too expensive, and I can say that because this is the pot calling the kettle black here with my background. But you can use those things to help pay for expenses for the kid with that other money that they have earned.
Right.
And the best way to do that is to then have your kid make $1,000 an hour to come sweep the floor.
No.
All right, so let's get into that. Let's talk about then the rate and how we have to handle that to make this. Because again, what we talked about with Brandon last time was we know that we can't be so afraid of an audit that you can be, but I prefer not to be so afraid of an audit that you don't take advantage of these opportunities that are legitimately out there. But you want to have an auditable record for everything, and that includes doing things the right way. And so, not paying your kids $1,000 an hour for a job that typically pays $12 an hour.
Right. Well, they say pigs get fed, hogs get slaughtered, right? So that's a good rule of thumb, I guess, when you're dealing with taxes in general. But I will say this: so the amount you pay your child needs to be reasonable for the work they're performing and for what they're capable of doing at that age, right? Most younger, there's a tax court case out there that basically says that kind of where the taxpayer lost because their children for the children under 7, because the tax court found their children who were under 7 couldn't really provide meaningful work to the business. But the point of the matter is it has to be reasonable for what they're doing. So you're not going to pay a child $1,000 an hour to sweep the floor in your home office or in your regular office for that matter. They're typically, you have to look up. Typically what happens, honestly, most people are going to pay their child the minimum wage because there's not that much substantiation that needs to go into that. It's the minimum wage. That's what the child's going to get paid. Having said that, if you do have a child that's performing work that might be higher than minimum wage, you're going to want to go out there and come up with some form of substantiation of how you found that, right? There's different ways to do it, different levels of sophistication. You go on a website like Indeed or like Glassdoor or Salary.com, one of those websites, find out what role they're doing and kind of get an approximate salary there. That's one way to do it. Then there's ways you can go on the Bureau of Labor Statistics, find out what they're getting paid for what work they're doing, use that as substantiation. But there needs to be some kind of reasonable determination of you need to be able to provide some kind of path to how you came up with that decision, and it needs to be reasonable, right? If you just pull the number out of the hat, that's when you're kind of starting to get into the territory of you might run into some problems if you were audited.
All right, now I'm gonna put you on the spot here. So this is the one that I think there is a valid argument to this one, and that's modeling.
Right.
So I've got a business that runs by, let's say that I'm trying to grow this podcast, and I don't. If the podcast grows, then it grows, and it's for the glory of God and fantastic. But if it doesn't grow and it's just you and me and the crickets that are listening, then so be it. I'm sorry for wasting your time. So let's just take just the podcast. All right. If I make a post about me and I post something in the podcast and it gets 5 likes or 10 likes, I don't even know what it does. But if I post a picture of my kids on there with it, then it gets 10 times the amount of views and likes and activity or more.
Right.
And so that can say, okay, well now there is real value that comes from paying from having my kids model, and the modeling rate is not a minimum wage rate, and so we know that there's something there. But I talked to those CPAs about this, and they said yes, but you can still go to a modeling rate, and a modeling rate, there's still something there to it. It's still not $1,000 an hour for a modeling shoot. The difference there is if I post pictures of someone else's kids compared to my kids, it won't draw near the attention, and I don't really want to post pictures of my kids faces, right? With everything going on in the AI and deepfake space and everything else, I don't really want to post pictures of my kids. So if I'm going to do it, I honestly hold this to it, and I would stand before a court and say I hold that to a very high value. That if I'm going to do that it needs to be worth something substantial. So you don't necessarily have to go down that high horse I'm on there and justify that, but can you just talk a little bit to the idea of paying your children for modeling fees,
right?
And what someone should do there,
right? So in those situations, right? So if your child's younger, there's not much work they could probably practically do within your business, but you can pay them for photo shoots. Some people do biannual photo shoots of their children and use them in marketing materials, and as you kind of described there. that rate also needs to be reasonable. It needs to be determined on some kind of a reasonable basis. So if you go to the modeling rate, and you find out what the going rate is, like say, for example, if your child was to model for a third party, that's going to be a reasonable way to do it. Now, whether or not you can assign a higher value to that, based on, market, including your child and your stuff is worth more or less. That's a horse of another color. But the bottom line is that the bottom line is if you were to have them model, pay them a reasonable wage or reasonable rate for what they're doing for you, then you should be fine for the most part.
Okay. And so big piece of this is you need to be able to justify.
Right.
You need to be able to justify everything here. And so do the work to.
Yeah, I was going to say, because the issues with a lot of the stuff that we're talking about here, especially like paying your children, there's people, the tax code and tax court cases, this stuff has all been done before, right? And they're aware this is ripe for abuse. So chances are, if someone thought of a way to take advantage of this, it's probably been handled already. So that's why, like when we're talking about, like especially when it comes to paying your children, having a substantiation of how you came to that conclusion of that's how much you're going to pay them for the work they perform. That's why it just becomes super important.
And I'm gonna make another plug for you guys again here. Most CPAs don't dig into the court cases, and there are absolutely some who are really good. I've got some really good CPAs that I refer business to, and I'm really happy with, and they do understand that. But most of them don't get into court cases. They know what the code says, and that's kind of the end of that.
Yeah.
So having a resource like the Tax Smart Investors is absolutely an opportunity for someone to get in and ask these questions in a way that maybe allows them to continue staying with their CPA, or maybe expose it to them that, man, it's worth me paying. Brandon talked about the $5,000 up front to engage with Hall CPA. Like, it might be worth that, because I'm giving up a lot more because my CPA is so far from the line. Like if the line's here, like we never want to go all the way up to it, but some people want to stay, half a mile back from the line.
Right.
I think that's the issue.
Right. And you know what the tax court cases do? The tax court cases, like there's regulations and there's the actual statutory code, and that usually provides some guidance on how to navigate these situations. But then all of these like what ifs and how close are you to the line, and that's when you look at tax court cases, because kind of like I said before, chances are this stuff is someone's already kind of experienced this, and then you look at the tax court case and say, well, how did the tax court actually deal with this when this situation came up? And that just kind of adds a little bit more clarity, and it's something that that can really help you just understand, where that line is and how close to that line you can get before you kind of could get into some trouble or get into some, undefensible positions.
So real quick to wrap up this one, didn't get into reps here, but we are going to pound reps hard. Real estate professional says we're going to pound that hard in the next episode. But let's just kind of wrap up here with audits. So if I'm looking at this and I'm only going to get a few $1,000s of actual money back in my pocket because of these other deductions, worth it or not? And what is the chance that me taking a home office deduction, a vehicle deduction, and paying my kids, how much more likely does that make me to get audited?
So audit rates are quite low to begin with. So the chance of you getting audited from the start from the start is already pretty low. Now, when you do take certain positions, they can increase your audit rate. Generally speaking, if you take the home office deduction, you're probably not going to get audited unless you're being excessive on your expenses and like you have these just massive expenses that are just unreasonable. Like that could be a red flag. But if you're using the home office deduction, simply taking it in and of itself typically isn't going to increase your audit rate. Same thing with vehicles. You could potentially run into some issues if you purchase the wrong vehicle or like vehicles that are not ordinarily necessary for your business. So it could. But the point I'm trying to make with these, when it becomes excessive, and like you're looking at it and just like, okay, again, pigs get fed, hogs get slaughtered. If you're looking at it and if you're reasonable with these expenses, taking them in and of itself is not going to increase your audit risk. Same thing with your children. But if you're paying your children, $100,000 and the kid's, 14 years old or 10 years old, chances are, you might run into some issues, or that might be a red flag.
Yeah. Okay. All right. That is good. We're gonna wrap it up there. Thank you, Thomas, for all of the insight there. I think that those are just such common questions that people come across, and they just don't know. It's just not common to have someone, do a good in-depth job of explaining that. So I truly appreciate your time and expertise there. And we are looking forward to this next one here with real estate professional status. So hope you will join us next week as we dig into that next one there. If you aren't familiar with what that is, whether you wind up doing it or not, this would be a powerful source of information for you in the next episode here. So thank you, Thomas.
Thank you for having me, Eric. Thank you.
All right.
Thank you again for listening to Wealth Well Done. Be sure to subscribe to the show on your favorite podcast player, and together we'll continue to improve our relationship with money and our effectiveness in stewarding it well.